This is the last section. Talk about the normal times. So not boom bust, okay, but just normal fluctuations of value and stuff like that. So the normal payments clearing and so forth. I think that a key issue for making this Brave New World work, okay, is focusing on the operation of the payment system. We've been doing this throughout this semester, right? The survival constraint, liquidity kills you quick, all those things that I say, okay? That solvency never kills you, okay? It's liquidity that kills you. Well, there's not just payments liquidity, settlement constraint, okay? There's also collateral. And that's what this famous paper by Aitken and Singh is sort of about, is the role of collateral flows. And so I'm going to talk about both of those, okay? And I'm going to use our little model, but with some numbers on it. Okay, so you can see, this is the same model that I had before, okay? I've actually taken out foreign exchange swaps just to make it a little simpler. I'm showing that the Capital Funding Bank, I'm even using abbreviations to make it simpler, okay, has residential mortgage-backed security positions of 100 and is funding them in the money market, okay? And using these positions as collateral for that. So that's where collateral is coming in here. This is secured borrowing. Perhaps that collateral passes through the global money dealer to here, okay? So that this is a secured deposit of some sort. Perhaps not. By secured, like asset-backed commercial paper, repo, these are. So if this is a repo dealer, okay, the collateral can pass through and be backing this deposit here, for example. On the risk side, I'm showing CDS and interest rate swaps, and I'm valuing them at 0 because at the moment they're set up, they're equal and opposite positions, and we don't know who's in the money and who's going to win and who's not going to win. So when you set them up, they have a valuation of 0, and there's 0 over here on the asset manager's balance sheet, and there's 0 here on the derivatives balance sheet. Okay, the collateral issues for these derivatives are here. This asset manager is the one who has the exposure to risk. But this asset manager has a ton of deposits here, okay? Cash collateral, which he can put up. So if he loses money on any of these positions, okay, he can just transfer these deposits over here to the derivative dealer. And the derivative dealer may conceivably be able to then credit those deposits to the other side over here, okay? So the way it's set up, the way I've set it up here, is number one, that there's no necessary counterparty risk here, okay? Because it's just, I'm abstracting from counterparty risk, that the Capital Funding Bank is hedging its exposures. It's not over hedging, it's not under hedging, it's exactly hedging. So it doesn't have any particular risk. So that is not a problem, okay? And similarly, this asset manager has capital adequate to pay, even if the worst case that these residential mortgage-backed securities went to 0, that just means that the poor pensioners, okay, lose all the money. It's the capital of the asset manager here. So there's no counterparty risk in this model. Okay. Now, but there's other kinds of risk. There's liquidity risk. What happens if the value of these residential mortgage-backed securities fluctuates? What happens if it falls a little bit? Okay, just temporarily for any reason, who knows what? Okay, I'm not saying that we know that these things are not worth 100, but these are market prices. Okay, and so they can fluctuate. Prices don't stay as they are. And so that's what this next slide is showing. It's showing that the residential mortgage-backed securities fluctuate to 90. They're not 100 anymore, they're 90. And so the consequence of that, if CDS is tracking exactly, okay, CDS is now moving to 10. Okay, CDS is moving to 10. CDS is moving to 10 here. What needs to happen, okay, is collateral flows, okay, in order to in order to support this new liability of the asset manager, this new liability of the derivative dealer, okay, has to be backstopped with collateral flows. There also has to be new collateral because this money market funding of 100 is now not going to be backed by residential mortgage securities that are worth only 90. Okay? Remember, we saw this problem last time, that if you're putting these residential mortgage-backed securities up as collateral, there's not enough collateral anymore here. Okay? So in order to make this funding work, there has to be some way that you can use the CDS or the collateral in back of the CDS, which ultimately is coming from here. You know, these deposits are flowing through here, use these as collateral for that, okay? Otherwise, if these are, it may be that the global money dealer is willing to continue lending, but will the asset manager, these deposits here, if he's worried that that global money dealer now is lending to people who don't have adequate collateral, he may refuse, may pull his money out. So the whole thing could collapse. There could be a liquidity downward spiral just because of collateral problems, okay? That the security behind all of these promises starts to come into doubt. That's where a central bank can help, okay? And it can help, you could think of it as backstopping the dealers, because they're key, lender of last resort to the global money dealer and the derivative dealer, okay? So that if the collateral doesn't flow properly, basically the central bank can put itself in there, okay? And act as an intermediary. Alternatively, or in a complementary way, as dealer of last resort for the underlying assets. Residential mortgage-backed securities or CDS in this way, okay? Not as a lender to the dealers, okay, but as a dealer itself in these markets, putting a floor under them in the collateral market. So this is valuation fluctuation and collateral flows. The devil's in the detail with collateral, and that there's a lot of very technical discussion happening right now about collateral flows and rehypothecation. And rehypothecation just means you give me collateral and I can use it as collateral for something else. That's rehypothecation, okay? And some people are trying to make that illegal, okay? If you make that illegal, it's not gonna work here. It's not gonna work. It's gotta flow through the dealers. If it doesn't flow through the dealers, you're gonna have a lot of work of the central bank. Okay, and you really don't want that, okay? You want private agencies to deal with this as much as possible and use the central bank only in the last resort. A similar problem, but one that's probably easier to understand because we're used to payment problems. Suppose this fluctuation in value is permanent, okay? So we have to recognize these losses and make actual payments. So I'm just showing that we recognize these losses. CDS are moved to zero, and the whole system is shrinking. There's deleveraging, right? So that mortgage-backed securities are now appreciated. They're only worth 90. Money market funding of 90, okay? 90, 90, 0, 0. So we're sort of resetting the system. This all requires the asset manager to actually make a payment of 10 in order to cancel his CDS losses, a payment to the derivative dealer. That payment then needs to be made to the capital funding bank, which uses that payment to pay off the extra 10 money market funding, so you see, all these payments have to work, okay? They have to flow through without any loss that somebody says, well, I'm not paying you until I get paid. This is what happens in payments crises. It's like, I'm really worried that I'm not going to get paid, and therefore I'm not going to pay you. Well, everyone has to make these payments. It's a circle, okay? And if somebody stops, everything stops, okay? So the payments illiquidity problem is a serious problem in this world. So collateral flows and payment flows both are key to making sure that just normal fluctuations of value, okay, don't cause crises, don't cause liquidity downward spirals. If they do cause liquidity downward spirals, then you have the central bank there. But you want to, once the central bank has taken responsibility as dealer of last resort, the job, as in Badgett's day, is to say, well, I don't want to be dealer of last resort. How can I How can I regulate this system? How can I set up this system so that I'm not going to be called upon every day, okay, to do this? I don't want to do this because once I am, there's all kinds of moral hazard problems. And, you know, I really want the private sector to sort this stuff out, and I'm willing to be outside spread, okay, but not inside spread, okay? I'm there in case they screw up, okay, but not daily, not daily.